Ever pondered over the various types of financial derivatives that exist? Well, buckle up, for today we dive into the complex yet fascinating world of derivatives. First off, what are derivatives? In simple terms, derivatives are financial contracts that derive their value from an underlying asset. These assets could be stocks, bonds, commodities, currencies, interest rates, and even market indices. Derivatives are primarily used for hedging risk, speculating on future price movements, and gaining access to otherwise hard-to-reach markets. Now, let's dive into the different types of financial derivatives. First on our list are futures. A futures contract is an agreement to buy or sell a particular asset at a predetermined price at a specific time in the future. These contracts are standardized and traded on an exchange. For instance, an investor might agree to buy 100 barrels of oil at $60 a barrel in 6 months. The buyer of a futures contract is said to go long, and the seller is said to go short. Next up, we have options. Options give the holder the right, but not the obligation, to buy or sell an asset at a set price on or before a certain date. There are two types of options, calls and puts. A call option gives the holder the right to buy an asset, while a put option gives the holder the right to sell an asset. Thirdly, we have swaps. Swaps are agreements between two parties to exchange sequences of cash flows for a set period of time. Usually, at the time the contract is initiated, at least one of these series of cash flows is determined by a random or uncertain variable, such as an interest rate, foreign exchange rate, equity price, or commodity price. Lastly, we have forward contracts. Like futures, forwards are agreements to buy or sell an asset at a set price on a future date. However, unlike futures, forward contracts are private agreements between two parties and are not traded on an exchange. In summary, derivatives are financial contracts whose value is derived from an underlying asset. The four main types of derivatives are futures, options, swaps, and forward contracts. Futures and forward contracts involve the agreement to buy or sell an asset at a set price in the future. Options give the holder the right, but not the obligation, to buy or sell an asset at a set price. Swaps involve the exchange of cash flows between two parties. Remember, while derivatives can be used to hedge risk, they can also be used for speculation, which can be highly risky. Always ensure to thoroughly understand the terms and risk involved before venturing into derivative trading. And there you have it, a brief but comprehensive guide to understanding the different types of financial derivatives. So the next time you come across a derivative, you'll know exactly what it means. This has been a delightful journey, hasn't it? So until next time, keep those financial gears turning